Banks are often perceived as simple intermediaries, accepting deposits and granting loans. While these functions are fundamental, the reality of how banks generate revenue is far more multifaceted. Banks are, in essence, sophisticated businesses operating within a complex financial ecosystem. Their ability to generate profits hinges on effectively managing various income streams, each with its own risk and reward profile. Understanding these income streams is crucial to grasping the inner workings of the financial system and the role banks play within it. At the heart of banking operations lies the concept of leverage. Banks utilize deposits from individuals and institutions to fund loans and investments, aiming to earn a return that exceeds the interest paid to depositors. This fundamental principle underpins the generation of net interest income, the bedrock of banking profitability. However, banks have evolved beyond traditional lending and borrowing activities, diversifying their income sources to include service income and trading income. Service income encompasses fees generated from a wide array of banking services, such as account maintenance, transaction processing, and wealth management. This income stream provides a stable and recurring revenue base, less susceptible to market fluctuations compared to other sources. Lastly, trading income arises from banks' proprietary trading activities, involving the buying and selling of financial instruments like stocks, bonds, and derivatives. While potentially lucrative, trading income is inherently volatile and heavily reliant on market conditions. By effectively managing these three primary income streams, net interest income, service income, and trading income, banks strive to achieve profitability and financial stability. However, an over-reliance on any single income source, particularly the volatile nature of trading income, can expose banks to significant risks. A balanced and diversified income mix is essential for long-term sustainability and resilience in the face of economic uncertainty. Net interest income forms the cornerstone of banking profitability, representing the lifeblood of their operations. It is calculated as the difference between the interest earned on loans and investments and the interest paid to depositors. In essence, banks act as intermediaries, borrowing money at lower interest rates and lending it out at higher rates, profiting from the spread. Imagine a bank that accepts deposits from customers, offering an average interest rate of 2% per annum. The bank then utilizes these deposits to issue loans to individuals and businesses at an average interest rate of 6% per annum. The 4% difference between the lending and deposit rates constitutes the bank's net interest margin, a key indicator of its profitability. The stability of net interest income stems from its reliance on the fundamental economic activity of borrowing and lending. As long as individuals and businesses require credit, banks can generate income from interest rate differentials. Moreover, net interest income is relatively predictable, allowing banks to forecast earnings with a degree of certainty. However, net interest income is not without its challenges. Economic downturns can lead to decreased loan demand and increased loan defaults, impacting profitability. Additionally, central bank policies influencing interest rates can impact net interest margins. Nonetheless, net interest income remains a vital source of revenue for banks, providing stability and supporting their core lending activities. Beyond the realm of interest rate differentials, banks have cultivated a diverse array of services that generate substantial revenue through fees. Service income encompasses charges for account maintenance, transaction processing, wire transfers, currency exchange, and a plethora of other financial services catering to both individual and institutional clients. Consider the monthly maintenance fee levied on checking accounts, a seemingly small charge that, when aggregated across millions of customers, translates into a significant revenue stream for banks. Similarly, transaction fees on debit card purchases, ATM withdrawals, and online payments contribute to a steady inflow of service income. The beauty of service income lies in its regularity and relative insulation from market volatility. Unlike trading income, which fluctuates with market sentiment, service income tends to be more stable and predictable. People and businesses require these essential financial services regardless of market conditions, ensuring a consistent revenue stream for banks. Moreover, service income provides an avenue for banks to build customer relationships and foster loyalty. By offering value-added services and personalized financial solutions, banks can attract and retain clients, further bolstering their service income base. This customer-centric approach, coupled with the stability of service income, makes it an integral part of a well-rounded banking business model. Trading income represents the realm of high finance, where banks leverage their financial muscle and market expertise to capitalize on price movements in various financial instruments. This income stream arises from buying and selling assets such as stocks, bonds, currencies, and derivatives, aiming to profit from short-term price fluctuations or exploit arbitrage opportunities. Imagine a bank's trading desk anticipating a decline in the value of a particular stock. They may decide to short sell the stock, borrowing shares from other investors and immediately selling them in the market. If the stock price falls as predicted, the bank can repurchase the shares at a lower price, return them to the original lender, and pocket the difference as profit. While potentially lucrative, trading income is inherently volatile and subject to significant market risk. Price movements can be unpredictable, influenced by a myriad of factors such as economic data releases, geopolitical events, and investor sentiment. A miscalculation or unexpected market swing can result in substantial losses, as evidenced by the numerous trading scandals that have plagued the financial industry. Despite the risks, trading income remains an alluring avenue for banks seeking to enhance profitability. The potential for outsized returns, coupled with the intellectual challenge of navigating complex financial markets, attracts some of the brightest minds to this high-stakes game. However, excessive reliance on trading income can expose banks to unacceptable levels of risk, as demonstrated by the 2008 financial crisis.